Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Price action, simply put, is the direction of a security over time. Traders use it to get a general idea of where the price of a particular stock or security will go in the future. At the end of this video, I'll have an example trade using price action. Price action is used to determine the trend of a security. It will utilize trend lines, support and resistance zones, as well as candlestick formations to establish good entry and exit points for a particular trade. It serves as the foundation for technical analysis, but is highly speculative and subjective. A trend can go up, down, or sideways. It is determined by looking at a chart and analyzing where the highs and lows are during a particular time zone and time range. For example, looking at the candle formation here, we see a series of higher highs and higher lows, which would indicate that the stock is in an uptrend. Here we can see lower highs and lower lows forming, which would indicate that the stock is in a downtrend. When the price is not moving in an uptrend or a downtrend, it's said to be moving sideways or in a range. Usually when you get sideways trading after an uptrend, it is known as distribution. This is where buyers can turn into sellers and you start getting some weakness and buying pressure. And when you get sideways trading after a downtrend, it is known as accumulation. And this is where you can get new buyers step into the market and selling pressure starts to weaken. A trend line is a line that's drawn across a chart and it touches at a minimum 2 or 3 pivot points. A pivot point is a point where price changes direction on the chart. The more pivot points that meet the trend line, the stronger the trend line is believed to be. Trend lines are drawn with the belief that if price bounced off or failed to break through these pivot points in the past, that there is a high likelihood they will do so again in the future. A trend line can be both diagonal and horizontal. They're normally used to establish support and resistance zones. Horizontal lines are known as support and resistance lines. Support is confirmed when price touches the trend line and then pivots. The same is true for resistance. A resistance line can become a support line when price breaks through the trend line, pulls back, touches the trend line, and then pivots back up to the upside. Support lines become resistance when the opposite happens. Price breaks down below the trend line, pulls back up, touches the trend line, and then pivots back down. Support and resistance lines can provide potential buy and sell zones. Candlesticks and their configuration play a large role in determining what direction price is moving in and if it will continue to move in that direction. A candlestick can be seen as bullish, bearish, or neutral based on where it opens and closes. Some candlesticks can be seen as more bearish or bullish than others, and some are seen as neutral. These are just a few of the most commonly used candlestick patterns out of the possible hundred, if not thousands, of candlestick patterns that are formed. The position of the candlestick or candlesticks relative to the direction of price is very important. Price action helps set the foundation for technical analysis, or TA. It is used to help identify chart patterns and create indicators that will be used to predict future price movement and potential buy and sell zones. These are a few of the most common chart patterns used in TA. TA builds in the idea of price action and incorporates trend lines and indicators to identify patterns, divergence, convergence, and areas that appear to be overbought or oversold. Indicators can be overlaid on the chart or placed on a separate section below the main chart. Time interval and range are very important. They can lead to different ideas of where the trend and price are heading. For example, the images used earlier to show you how to identify an uptrend and downtrend were segments pulled from the 1-hour chart and viewed through a 5-minute chart. That's why it is always important to use different time frames to get a better idea of the overall direction of the price. Okay, so here's an example of some price action trading on Sofi stock. This is a stock that I've traded before plenty of times, so I am familiar with the way it trades and moves. On this particular stock, I'm using the 5-minute, 15-minute, the 1-hour, the daily, and the 3-minute to trade. And I will just use this to get an idea of the general sense of where the market's going and to find some potential entry and exit points. And based on the 5-minute, I can see here that in the pre-market, we had some support at the 1425 zone, where the previous day and its pre-market had some support. And we see here some resistance near the 1450 and also a little bit in the pre-market at 1445 5-ish, I guess we can say. It is pulling back, so let me go in there and put in my order 14. Say 14. I'm using a bracket order. I'm using a 1 to 2 or 2 to 1 risk reward. And let's go back. Where are we at? Let's get in there in case it fills. Okay. So if it fills at 26, I'll be risking 10 cents to the downside, and I'll be stopped out. If not, I'll get filled 20 cents up. So we can just sit here and wait, see what happens. And you will probably see this happen in a few seconds, since it will probably be fast forward. Okay, looks like we're about to hit that profit zone. And there you have it. If you found this information helpful and would like to see more videos like this, or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching, and have a great trading week.